Welcome, market participants, to another Three Things in Credit. I'm Van Hesser, Chief Strategist at KBRA. Each week, we bring you three things impacting credit markets that we think you should know about. All right, we're down to 40 days until Election Day. Markets continue to rock, and the flood of new issuance continues. So much for the slowdown. Now, speaking of the election, we continue to watch closely the outcome that really matters to markets: gridlock. According to Polymarket, the likelihood of a Republican sweep, that's presidency, House, and Senate, is just 30%, while the prospect of a Democratic sweep is 21%. We can all take comfort in those numbers. Now, this week, our three things are: 1. Robust earnings growth forecast. Does that make sense? 2. CFO sentiment. We get conflicting views from two recent surveys. And 3. Trade shock. Keep an eye on the Longshoremen. All right, let's dig a bit deeper. Robust earnings growth forecast. So I made a presentation the other day where I highlighted the consensus earnings growth forecast for the S&P 500 in 2025 to be a whopping 14.3%, more than double the long-term average of 6%, and that's off of 9.3% expected for this year. Double-digit earnings growth is forecast for 7 of the S&P's 11 sectors, including the cyclicals. Consumer discretionary expected to be up 15%, industrials up 15%, materials up 16%, and energy up 12%. I refer to this as the Alfred E. Neumann forecast. For those who have no idea who Alfred E. Neumann is, and I know from an informal poll I took of those listening to my presentation that there are many, Alfred E. Neumann is the wily, teenage, fictitious icon of the irreverent comedy magazine from another era, Mad. Alfred's tagline, delivered with a crooked, gap-toothed smile, was, "What? Me worry?" And I thought about Mr. Neumann as context for the earnings forecast because, well, there is plenty to worry about. Starting with growth. It's forecast to slow from an estimated 2.5% in 2024 to 1.7% in 2025. Consumer spending is forecast to slow from 2.2% in 24 down to 1.8%. Business investment is expected to slow from 4% to 2.6%. And government expenditures are expected to slow from 3% to 1.3%. You get the picture. As we have talked about in the past, when talking about growth, we also believe direction of travel matters. So even though growth of 1.7% overall is fine for an economy this large, recall the Fed's longer-term growth estimate is 1.8%, when growth is slowing, a behavioral phenomenon, a conservatism, kicks in. That's a very natural human instinct for consumers to borrow less and spend less, for business managers to hire less and invest less, and for investors to pare back risk. Earnings growth of 14.3% in this environment sounds like a tall order. Moreover, embedded in that forecast are high margins. It's easy to see how they got that way. As inflation moderated in 2024, the effects were felt immediately on a firm's expense line, but pricing to the end user remained firm, out of inertia, no doubt. But that only lasts so long. Eventually, those excess profits get competed away. That's all very mechanical. So why are consensus operating margins forecast to take another leg up in 2025 to a historically high 16.8%? Then there is the issue of geopolitical risks, which are more elevated than just about any time I can think of. Worsening wars in Ukraine and the Middle East, a particularly consequential U.S. election full of policy uncertainty and prospects for market disruption. And then there is the wild card of China, a critically important cog in the wheel of global strategic and economic order, and where much is not going in the direction that is favorable to the West. All of these have the potential to act as headwinds to growth and margin. Now, don't misinterpret our cautiousness. The U.S. economy is on solid footing, and Jay Powell just might have pulled off his soft landing. But 14.3% earnings growth in 2025 strikes us as fanciful. All right, on to our second thing, CFO sentiment. Chief financial officers are less than enthusiastic about future prospects for growth. So says Deloitte, drawing on its third quarter North American CFO Signals survey. CFOs remain largely optimistic about their economic trajectory. Wait, what? That headline comes from the CFO survey, done in partnership by the Federal Reserve Banks of Richmond and Atlanta and Duke University's Fuqua School of Business. Two conflicting results from similar surveys. What's going on? Now, I will point out that there is a modest geographic difference between the two surveys. Deloitte's gathers responses from CFOs across the United States, Canada, and Mexico, while the one from the Feds and Duke is pan-US only. But those conclusions seem to be telling quite different stories. Let's dig in a bit and see what we find. In Deloitte's survey, the U.S. election is a big deal. 58% of CFOs surveyed said the outcome is extremely or very consequential for their organizations. Just 3% said it will not be consequential at all. Of the top 4 concerns cited by respondents, 3 are directly impacted by the election. The number 1 cited concern, geopolitics, were cited by 56%. The number 3 most cited was trade policy and tariffs, cited by 39%. And the number 4 was changes in tax policy, cited by 37%. The number 2 concern was the economic environment, 41%, something that probably accounts for the CFO's average year-on-year earnings growth forecast for the next 12 months to be a meager 2.1%, a far cry from the 14.3% estimate that was, of course, for full year 2025 we just laid out in our previous thing. Now, just 14% of CFOs consider the North American economy as good, and only 19% see it improving in a year. No wonder just 12% see this as a good time to be taking greater risks. A year ago, that number was 41%. And contrast this finding with Jay Powell's recent characterization of the U.S. economy as strong overall. The results from the Fed Duke survey seem to be from a parallel universe. Some 61% of respondents are optimistic about the U.S. economy. Nearly 1/3 expect economic growth over the next 12 months to exceed 2.5%, while just 13% expect negative real growth over that time frame. Some 40% of firms expect to increase capacity in the next 6 months. It is worth mentioning, however, that 44% say that concern over the U.S. election has led them to postpone or scale down or delay indefinitely investment plans. So it's not all puppy dogs and rainbows. So how do we reconcile these two surveys? I guess you can be less than enthusiastic about future prospects for growth, but still largely optimistic about your economic trajectory. Taken together, the surveys suggest to us that growth is slowing, but it is not falling off that proverbial cliff. Both acknowledge the U.S. election introduces a point of uncertainty into their decision-making. And concern over geopolitics in general has risen significantly as a risk factor, weighing on their firm's behavior. But net-net, there is an undercurrent of caution evident in these surveys. All right, on to our third thing, trade shock. East and Gulf Coast ports, including 5 of the 10 largest in the country, are preparing for a strike by the International Longshoremen's Association, which could begin October 1 if an agreement on a new contract is not reached in the meantime with the United States Maritime Alliance. Dock workers are looking for higher pay and prohibitions against automation. Now, some 60% of container shipments pass through affected ports. Analysts at J.P. Morgan Chase estimate that a strike could cost $5 billion a day, equal to 6% of daily GDP. Moreover, for each day ports are shut, JPM analysts estimate it could take 6 days to clear the backlog. This would not be welcome news to shippers which have already been affected by disruptions in the Red Sea and Suez Canal, as well as reduced capacity at the Panama Canal. The threat brings back memories of COVID-related port snafus that roiled supply chains in 2021 and 2022, and, among other things, catalyzed the highest inflation in 40 years. Logistics firm Flexport says if the strike lasts more than a few days, the effects could be worse than what happened during COVID. The firm estimates that 15% of the world's container ships would be offline as a result, creating pricing spikes and snarled supply chains. That amounts to higher costs, including those related to contingency shipping arrangements, manufacturing delays, and spoiled perishables. Much of that, presumably, would be passed along to consumers. And needless to say, this has the ability to weigh on the U.S. election outcome. It's worth keeping this on your radar. So there you have it. 3 things in credit. 1, robust earnings growth forecast. It strikes us as a stretch. 2. CFO sentiment. Sifting through the results of recent surveys suggests a conservatism regarding risk-taking. And 3. Trade shock. Keep an eye on the Longshoremen. As always, thanks for joining. Don't forget to check in on kbra.com for our ratings reports and our latest research. We'll see you next week. Hello, listeners. Join me, Van Hesser, KBRA's Chief Strategist, for in-depth conversations with credit experts in my new monthly podcast, Leading Voices in Credit, where I'll interview market professionals on the latest trends in credit markets. That's Leading Voices in Credit with Van Hesser. Subscribe now.